I am Reed, I am 27, just an average dude. I've made tons of money mistakes in my 20s, and now I want to share everything I've learned to help you take control of your finances and your life. So I was scrolling through the news the other day, and I saw something that just didn't sit right with me. It was one of those things where you look at two headlines side by side and you go, wait a minute, something is broken here. On one hand, you have the Japanese stock market Nikkei 225 absolutely ripping to new all-time highs, up like 15% this year, smashing through 58,000 points for the first time ever. Major export companies like Toyota and Sony, their stock prices are going absolutely nuts. Every surface level data point is screaming party time, bull market, everything is awesome. But then you look at the other headline and it's like looking at a completely different country. The yen is literally falling off a cliff, hanging around 160 to the dollar. It has lost nearly 40% of its value in just 3 years. Even Moody's economists are coming out and saying, look, this doesn't make sense. The yen is way weaker than it should be. And I'm sitting there in my tiny apartment thinking if my personal finances were this contradictory, I would be panicking right now. And honestly, if you are an ordinary person just trying to build some savings or invest your hard-earned money, you need to understand what is actually happening here, because the standard rules of economics seem to have just completely broken down. Normally, when a country's stock market is hitting new highs, the currency should get stronger, right? It's basic supply and demand. Foreign investors want to buy Japanese stocks, so they need yen to buy them. So demand for yen goes up and the yen strengthens. That's the textbook version at least. But we are not living in a textbook, we are living in 2025, and the rules have been thrown out the window. And here's the really crazy part. The Bank of Japan is actually raising interest rates. They hiked rates in December last year, then again in January this year. They are at 0.75%. Now, that should theoretically make the yen more attractive. Higher interest rates mean higher returns for holding yen, right? Wrong. The yen is still getting slaughtered. It is like a boxer who keeps getting hit and just cannot get off the canvas. And the reason why is something I want to break down for you today, because it reveals a truth that is honestly kind of terrifying for anyone who is invested in the stock market, especially if you are holding tech stocks or AI-related funds. Let me paint you a picture in the simplest way possible. Imagine you walk into a bank and they offer you a loan at an interest rate of less than 1%, almost free money. Now imagine you take that free money and you go buy a bunch of stocks that are guaranteed to go up 30 to 50% this year. Would you do it? Of course you would. You would borrow as much as humanly possible. You would borrow your rent money, your grocery money, your grandma's retirement fund. You would do whatever it takes. That is exactly what the biggest hedge funds on Wall Street are doing right now with the yen. They are treating the Japanese yen like it is an ATM machine with no password and no daily withdrawal limit. The operation is brutally simple. They borrow yen in Japan at near zero cost. They swap it for US dollars. Then they take those dollars and they pile into the US stock market, specifically the AI trade, the chip stocks, Nvidia, TSMC, everything that has buzzwords like artificial intelligence attached to it. Then when they cash out, they swap the dollars back to yen, pay back the loan, and pocket the difference. The interest rate gap plus the stock price gains equals pure free profit. At least that is how it looks on paper. You might think, oh, that is just the classic carry trade, and you would be right. Finance people have a fancy name for it. They call it the yen carry trade, but the scale of it, my friends, is absolutely mind-blowing. Let me drop a number on you. Back in January, the Commodity Futures Trading Commission here in the US released data showing that hedge funds and speculators held the largest net short position on the yen since 2010. Bloomberg reported that these funds collectively had a bearish bet against the yen worth about $28 billion. Let me say that again. $28 billion betting against one single currency. That is not one fund. That is the collective global speculative attack on the yen. And here's the thing that really got me in April. The Japanese government actually stepped in and tried to fight back. They spent $34.5 billion of their own money buying yen, trying to prop it up. Think about that for a second. The government spent $34.5 billion to defend their currency. And what happened? The yen took a small breath, recovered for like a day, and then immediately fell right back down to 160. The $28 billion short sellers versus the $34.5 billion government intervention. And the market did not even blink. Why? Because the logic of shorting the yen is just too damn strong. It is so strong that Wall Street does not even bother pretending anymore. The Bank for International Settlements actually called this out in a report in May, saying that speculative trading holding large net shorts on the yen is the clearest signal of an active global carry trade. But here's the part that really makes my blood run cold. That $28 billion in borrowed yen did not just sit there. It got converted into something specific. It got converted into Nasdaq chip stocks. It got converted into Nvidia and TSMC and basically every AI adjacent American tech giant. Think about the timeline. In January, these hedge funds were shorting the yen like crazy and piling into us tech. By May, the semiconductor ETF was up over 60%. Do the math with me here. You borrow money at less than 1% cost. You buy an asset that goes up 60%. You do not need to be Warren Buffett to understand that is a ludicrously good deal. You just need to be able to do basic multiplication. That is the first face of the yen in this whole story. It has stopped being a normal currency long ago. It has become the cheapest fuel for the global AI party. The cheaper the yen gets, the cheaper it becomes to leverage up and buy American tech stocks, and the more the party on Wall Street rages on. Wellington Management, a firm that manages over $1 trillion, wrote an analysis earlier this year with a line that is so brutally honest it stuck with me. They said last time the carry trade unwound on a large scale, the biggest impact was not in Japan and not in the Forex market. It was in U.S. momentum stocks. Read that sentence again slowly. If the yen carry trade blows up, the first place to bleed is not Tokyo. It is the Nasdaq. That is how twisted the relationship has become. Let me be real with you for a second. The yen carry trade is not fundamentally about betting against Japan. It is about using Japan as leverage to bet on America. The people borrowing yen do not care about the Japanese economy. They do not care about Japanese families. They care about one thing: how to use the cheapest money in the world to buy the most expensive AI dream in the world. The Bank of Japan raised rates to 0.75%. For an ordinary Japanese person, that is a nightmare. That means their mortgage just got more expensive, their cost of living just went up, life is getting harder, but for a Wall Street whale, what does 0.75% mean? It means the cost of capital went from basically free to still incredibly cheap. You do not stop driving your car just because the gas price went from $2 to $2.50. Not if the destination is worth it. And right now, the destination is the AI stock rally, which has been printing money for over a year. So the Bank of Japan raises rates, and what happens? The yen gets weaker. How is that possible? Because theory is one thing, and reality is another. The Bank of Japan is at 0.75%, but the Federal Reserve is sitting at 4.25 to 4.5%. Let that sink in. You can borrow in Japan at 0.75%, and you can deposit in the US at 4.25%. That is a nearly 4% risk-free interest rate gap. That gap is so wide that the Bank of Japan would need to hike to 1% or even 1.5% just to start closing it. And they cannot do that because of reasons I will get to in a moment. As long as the US keeps rates high and as long as AI stocks keep going up, Wall Street has absolutely zero incentive to stop milking the Japanese ATM. Now, let me tell you about the second face of the yen, and this one is not about greedy Wall Street bankers. This one is about real people getting crushed at home. In Japan, in February, CNBC ran an article with a title that basically said Japanese stocks are at record highs, but this rally might be fragile. They quoted an investing veteran who said this rally is not driven by economic fundamentals. If you look at how the currency is moving and how the economy is performing, there is nothing particularly strong supporting this market. And he was absolutely right. Japan's GDP actually shrank in the third quarter of last year. It contracted at an annualized rate of 1.8%. That was the first contraction in 6 quarters. But at the exact same time, the Nikkei 225 was smashing records. Auto stocks, electronic stocks, machinery stocks, all going crazy. You might think that is absurd, but it is not absurd at all when you understand how the revenue structure of these companies works. Think about it. Toyota, Sony, Hitachi, what do they have in common? They are exporters. They sell products to America, to Europe, to Southeast Asia. They earn hard currency, dollars and euros, but when they report their earnings on the Tokyo Stock Exchange, they have to convert all those dollars back into yen. And when the yen is falling like a rock, those dollars convert into way more yen than they used to. The revenue numbers look massive, but it is not because the company suddenly became more competitive or more innovative. It is because the measuring stick got shorter. Toyota reported their fiscal year 2026 earnings in early May. Their full year revenue hit an absolutely insane 50.68 trillion yen. You have to ask yourself how much of that number would disappear if the yen was actually strong. Moody's economist described it perfectly. The yen being severely undervalued is basically the invisible hand pushing the Japanese stock market up. Invisible hand of currency depreciation, not productivity improvement, not technological breakthrough, just pure monetary distortion. Meanwhile, on the other side of the coin, data from April showed that Japanese household spending had fallen for the third month in a row. Real wages adjusted for inflation were down 1.4% year over year. That was the 9th consecutive month of decline. 9 months, go to a supermarket in Japan right now and you will see it. Soy sauce is more expensive, rice is more expensive, electricity bills are up, gas bills are up because Japan imports almost all its energy. Every drop in the yen means every barrel of oil, every ton of LNG costs more in yen terms. Ordinary people might see a tiny bump in their nominal paycheck, but what they can actually buy with that paycheck is shrinking. That is the cruelest form of inflation. It is not because you are lazy or bad with money, it is because the money in your pocket is literally worth less than it was last year. And on the other end of that pipeline, the shareholders of those export companies, the executives, the overseas investors holding Nikkei ETFs, their wealth is ballooning on the back of the yen collapse. Always remember, wealth does not disappear. It transfers from the Japanese salaryman getting paid in yen to the hedge fund manager holding dollars, from the housewife buying rice to the foreign investor cashing out of Japan stocks. It gets sucked out of one pocket and dumped into another. According to OECD data from December last year, Japan's GDP per capita ranking among the 38 member countries dropped to 24th place, that is behind South Korea. The former second largest economy in the world, the miracle of Asia, now ranking near the bottom of the developed world club, that is the second face of the yen. It is a brutal, invisible wealth conveyor belt. It uses a weak yen to fatten the earnings reports of export giants, and it uses the shrinking purchasing power of ordinary Japanese people to subsidize the returns of global investors holding Nikkei index funds. You might ask, well, why does the Japanese government not do something about it? The export companies are making record profits, tax revenue should be up, why not use that money to give subsidies to ordinary people? The answer is honestly even more depressing. First, a huge chunk of those inflated profits never even comes back to Japan. It sits in overseas subsidiaries. Why would you convert dollars back into a rapidly depreciating yen? That would kill your profit on paper. So the money stays abroad, it does not come home to invest in Japan, it does not get used to raise wages for Japanese employees. Then in November, the government announced a big $135 billion stimulus package. Tax cuts, subsidies, handouts. Sounds good, right? But where does the money come from? Borrowing Japan already has the highest debt to GDP ratio in the world. They are using borrowed money to fill a hole that gets bigger every day. And if interest rates ever go up meaningfully, that borrowed money becomes a trap that snaps shut on the entire economy. So the cycle is perfectly closed. Exporters benefit from the weak yen, but keep the profits overseas. The government tries to help people by borrowing more money, which makes the debt worse, which makes the central bank afraid to raise rates. The central bank stays dovish, the yen keeps falling, and the exporters keep winning. The only one getting run over again and again is that ordinary household trying to make ends meet. Now I want to show you the third face of the yen, and this one is the scariest of all. It is buried deep in the balance sheet of the Bank of Japan. And it is the real reason why the yen might be fundamentally unsalvageable for the foreseeable future. Here's the situation. The Bank of Japan is sitting on a mountain of Japanese government bonds so massive, it makes Mount Fuji look like a pebble. By the end of 2025, the Bank of Japan's total assets are estimated to be around 697 trillion yen. That is over 4 trillion US dollars. And the vast majority of that is Japanese government bonds. What does it mean when a central bank holds government bonds? It means the government owes a ton of money, and the central bank is essentially printing money to buy up that debt and keep the system running. How much debt does the Japanese government actually have? According to the IMF, Japan's debt to GDP ratio is around 255%. That is the highest in the world by a long shot. For context, the US is around 120%. Japan is at 255%. The country owes more than twice what its entire economy produces in a year. If any other country had that number, rating agencies would have downgraded them to junk status a long time ago. The only reason Japan is still standing is one extremely fragile condition. Interest rates absolutely cannot go up, because if they do, the interest expense on that massive debt will eat the government budget alive. According to Japan's own finance ministry, if long-term rates rise to just 2%, the annual debt servicing cost would balloon to nearly $230 billion. That is almost one-third of the entire government budget. One-third of your tax money just to pay interest. What about education, healthcare, defense, infrastructure? You cannot pay for any of that. If a third of your budget goes to interest payments, and here is the killer. The Bank of Japan itself is the single biggest holder of Japanese government bonds. If interest rates rise, bond prices fall. And when bond prices fall, the Bank of Japan's balance sheet takes a massive unrealized loss. We are talking about losses so huge they could trigger a financial meltdown. Just last fiscal year, Japan's 4 major insurance companies reported combined unrealized losses of around $6 billion on their domestic bond holdings. That is just insurance companies. At the central bank level, the numbers would be astronomical, so now you understand why the Bank of Japan simply cannot raise interest rates aggressively. Every quarter-point hike makes the government's debt payments jump, and it punches another hole in the central bank's own balance sheet. The one move that could actually save the yen a massive rate hike is the one move that would blow up the entire Japanese government bond market. This is what economists call a death by two choices. You can either hike rates, hard risk, triggering a sovereign debt crisis, and try to save the currency. Or you can let the currency keep crashing, let the carry trade keep bleeding your country dry, and avoid the debt bomb. The Bank of Japan has cowardly chosen the latter. Governor Ueda has been walking a tightrope since he took office. He carefully nudged rates up to 0.75%. But the sharks on Wall Street have already read his poker hand. They know he is bluffing. They know he cannot go all in. Their attitude is basically, we know you are in a tough spot, but we do not care. Your rate is 0.75% and ours is 4.25%. We can keep playing this game for another year, 2 years, 3 years. That is the third face of the yen. It is a hostage tied to a mountain of debt. As long as that 255% debt ratio does not come down, the yen will never have the strength to truly recover. So let me put all three faces together for you. The yen is the cheapest fuel for the global AI rally. Wall Street borrows it like crazy to buy Nasdaq stocks. The yen is an invisible domestic wealth redistributor. It takes purchasing power away from ordinary Japanese people and gives it to export companies and foreign investors. And the yen is a hostage to the most insane debt burden in the developed world. The central bank cannot rescue it without blowing up its own financial system. These three forces are all running at the same time, and they all point to one cold conclusion. The yen is trapped, and it is probably going to stay trapped for the foreseeable future. But I want to leave you with one final thought, because this is the part that really hits home for me as just an ordinary guy trying to figure out how money works.